Hey guys, welcome back to the channel. My name is Rob and I have been traveling the world for the last 8 years as an early retiree, and I started this channel to help people with their retirement investing. As always, I'm not a financial advisor, so please do your own research and make your own decisions. Don't take this as financial advice. And today we're talking about a beginner's guide to the S&P 500 ETF, ticker symbol VOO. If you've talked to us at one of our meetups or people talking about where they should start investing, this is the one that's always going to come up, VOO. It is where we recommend people start their investing journey when they're just starting out, because it is kind of the benchmark that everything else is measured against. When people talk about things like, oh, I'm beating the market or I didn't beat the market, when they say the market, they're talking about VOO, which is the S&P 500. So if you're new to investing, we're going to dive in today about what this is, how you can invest in it, and what the benefits and what some of the drawbacks are to investing in VOO. So this is an ETF, and an ETF is a mechanism where you can invest once into one ticker, VOO, and you will be owning a bunch of different companies. So this one specifically, you'll be owning 500 companies, which is the top 500 companies in the US usually. So this is a great one. Think this is filled with companies like Apple, Microsoft, Amazon, and you're buying those all in one purchase. You don't have to buy them all individually. You're just buying this one ticker symbol and you're getting 500 companies from the US. So it's great for diversification, it's great for simplicity, and it's great for a lot of other reasons. It does track about 80% of the US stock market, and it covers all sectors. So you're gonna get tech names like NVIDIA, you're gonna get healthcare like Johnson & Johnson, and you're gonna get financial stocks like JP Morgan, things like that. Now it is updated quarterly, so 4 times per year. They will take low performing stocks out of the index and replace them with other stocks that are going to be better for the index. So that is a great part of it, is that it is something that you don't have to manage. They're just going to do that automatically for you, and you don't have to be worried about, well, if one of my companies starts to do poorly, should I sell that and get something new? If you have this, that's all going to be done for you behind the scenes. That's one of the reasons that this is a great ticker to invest in for beginners. Now, performance-wise, it does have a 10% average annual return since 1957, including dips like 2008 and 2020. That's why people consider this to be the benchmark that they're comparing themselves against, is that this has a very long historical track record of being very tough to beat for individual investors. So we always say that if you're a beginning investor and you don't know what to do, you can almost never go wrong just buying VOO. So if you don't know where to put your money, you don't know what you're going to buy, just buy some of this or buy more of this, and it will usually, pretty much always, over a 10-year period, be a good decision in hindsight. It won't always have the same explosive growth as some individual stocks might have, but there is much, much, much less downside. So if you're not sure what to do, this is definitely something that is wise to invest in. Let's go over what you're actually getting, because when you buy something, you do need to know what you're buying. That way, when the market is going down, you have confidence that what you've bought is something good and you won't feel pressured to sell it. So let's go over what is actually in this. It does hold the S&P's 500 stocks, but 10 of the stocks, the top 10, do account for 38% of its value due to the large market caps that those stocks have. So the top stock in the index right now is NVIDIA. It does account for 8% of the funds. So basically, if you put your money into this, you're basically buying this for around $600 per share. 8% of that is going to NVIDIA, 7.3% is going to Microsoft, and so forth. As the companies go down, the amount of money of those $600 that's going to each company gets less and less as we go down. The third largest holding for the ETF is going to be Apple. Fourth is going to be Amazon at 4%. Then we have Meta, which is Facebook, Broadcom, Google, Berkshire Hathaway, and Tesla. Those are the top 10 stocks that make up the 38% of the holdings of this ETF. So I do want to point out that these weights will shift over time. So as companies get bigger or smaller and they do well or they do poorly, the weighting will shift, which again is so amazing with this that you don't have to reshift all of that yourself. It's all going to be done automatically. It happens every 3 months and you won't even notice it. It'll just happen and you don't have to do anything. So this truly is the kind of stock you could buy today and come back in 20 years, do nothing, and it will have done well because it will be changing and evolving the entire 20 years every 3 months with the market and with how things are going in the world. So from that standpoint, it is a great thing to do. Now, anytime you have an ETF or someone is doing this for you, there is an expense ratio. There is, basically think of that as a fee for them doing this, but the fee is very, very low on this particular ETF, which is why it is recommended. Vanguard has very low fees. It's a 0.03 expense ratio, which means for every $10,000 you have invested, they will charge $3 per year to do this for you. Now think about that. If you really can't get much better than that, because $3 per year for $10,000, if you have $100,000 invested in this, $30 per year, that's almost nothing compared to how much you have invested. And if you went to have someone manage this for you or hired a financial advisor, they're going to charge you way, way, way more than this. And odds are they can't do better than this anyway. So this is really the go-to, unless you have some very unique and special situation. This is the go-to for what should make up the core of your portfolio. We have other videos on the channel where we talk about your core holdings, and this should make up the core of your portfolio. This should be, for most people, their biggest holding as they are trying to grow their income, because it is a stabilizing force of diversity, growth, and low income expenses. Now, what it is not is one that will earn high dividends. So if you are looking for income in your retirement, this is one that you will need to shift out of once you are looking for income to live on, because it is filled with companies like Nvidia, Meta, Google, and Amazon who don't really pay high dividends. This as a whole will not be getting you the dividend income that you need if you're looking to retire off of dividends in the future. So something that you can buy while you're trying to accumulate your wealth, and then you would probably transition from this to something else, or out of this partially to something else if you're looking for dividend income later on. So the benefits to this are large. As I said, diversification is amazing. The low fees are amazing. And the growth has been phenomenal. $10,000 invested in this fund 10 years ago is now worth $40,000. So you've 4x'd your money in 10 years if you invested in this 10 years ago. That's hard to beat just doing things passively. And again, looking back over pretty much every 10-year period, it's hard to find a time when this did not do well and outperform most other assets. So what are the risks? There are some risks, of course, with everything you're going to do. And that is that the market is volatile, and there can be short-term risks. 2022 was a down year. 2020, of course, had some downside, and 2008 had downside. So if you're getting in this with money that you're going to be needing 6 months from now, that is a little more risky, because you cannot guarantee over a 2-month, 6-month, 1-year time period that anything will do well. If that's the case, you need something safer, like a bond, or looking into SGov, something that's going to be a little more stable. But over a 3-year, 5-year, 10-year period, it is very hard to beat this. So if you have money that you aren't going to need in the next 6 months to a year, then it is very tough to beat this. And I would say If you don't know what to do, just put it in this VOO. The other limiting factors of this is that it is US focused, so you will not be investing anything outside of the US. Now, traditionally, this has been a positive because US stocks have outperformed international stocks. So if that does continue, then this would be a positive. If for some reason international stocks started outperforming US stocks, then that would be a negative for that. But that has not been the case throughout most of the history. Now, how do you invest in this? So get yourself a brokerage account, something like Fidelity, Schwab, Robinhood, Webull, one of those brokerages, and just buy ticker symbol VOO. Right now, the one share is costing right around $600. So it is important that if you're a new investor and you don't want to be investing $600 at a time, that you look for a platform that will let you invest in fractional shares. So in other words, some investing platforms make you buy one whole share at a time, in which case each time you wanted to buy this, you'd have to put the entire $600 in. Other more online focused platforms like Robinhood or Webull, they'll let you buy fractional shares. So you could buy $60 worth and you'll get 0.1 or a tenth of a share. And those can be easier because this type of investment, the stock price is quite a bit higher. And a lot of people don't have $600 to invest all at once. So if you want to be investing fractionally, just make sure that your broker lets you do that before you sign up with them. Again, ones that do let you do that for sure are Robinhood and Webull. So those are two that are good if you're going to be investing into this. Start small. You can dollar cost average into this over time. That is the thing that most people do, is just buy some of this every week, buy some of this every month. And it is a great investment because looking back in time, it's the one investment that everybody points to and says, it's really hard to beat. It's just really hard to beat. So you cannot really make a mistake investing in this if you have a long time frame. Guys, I know you have questions. Leave them in the comments for me. Hopefully this video was helpful and introduced you to VOO and how it can benefit you as an investor and as a retiree. If it was helpful, please give me a like on the video. Subscribe to the channel if you haven't already, and I will see you on the next video.